Good morning. In the last class, we have understood why accounting, what is single entry bookkeeping system, what is double entry bookkeeping system, what are the different kinds of accounts, and what is debit and credit. Today, we will be learning one of the most important thing without which we will not be in a position to do any problem in accounting. This is what I call as rule of debiting and crediting. If you don't know these rules of debiting and crediting, different accounts will be doing wrong thing or will be posting the transaction in a wrong way. So let us understand what these rules are relating to debiting and crediting the various accounts. These rules will state which item has to be entered on the debit side of the account or credit side of the account. Which item to be debited or credited will definitely depend upon the nature of the account. The nature is relating to whether the account pertains to the personal account or a real account or a nominal account. Depending upon the nature of the account for which the transaction or a particular event is happening, based upon that particular thing, we need to either debit the account or credit the account. Let me repeat, whether the transaction pertains to the personal account or a real account or a nominal account, on the basis of that, the rule of debit or credit will be there. Let us proceed. If the transaction is pertaining to personal account, if the transaction pertains to a personal account, we need to debit the receiver and credit the giver. Let me repeat, if the transaction pertains to the personal account, what is personal account? Personal accounts relates to individuals like Rama, Krishna, or Rama and Sons, or L&T company, or a Reliance company, or it may represent artificial persons or real persons. When it belongs to transaction belongs to personal account, we always need to remember that we need to debit the receiver and credit the giver. Debit the receiver, credit the giver. What do you mean by that? Debit, whenever somebody is receiving something, his name has to be debited. Whenever somebody is being paid, we have to credit the giver. Okay, so debit the receiver and credit the giver. For example, if Ram pays rupees 500 to Sham, if Ram pays 500 to Sham, as both Ram and Sham are related to personal accounts, we need to debit the receiver account and credit the giver account. Debit the receiver account. Who is receiving this particular payment? Ram pays rupees 500 to Sham. Who is receiving? Sham is receiving. So his account is going to be debited. His account is going to be debited and a Ram account is going to be credited. Let me repeat. In the case of personal accounts, we have to debit the receiver and credit the giver. If such is the case, we have to identify who is receiving and who is paying. The receiver account has to be debited as per this particular definition. Debit the receiver because Sham is receiving it. Sham account is going to be debited and Ram account is going to be credited because Ram is the giver. Ram is the giver. So this is how we are going to post in accounts when it is related to personal accounts. When it is related to asset account, when it is related to an asset account, real account, what will be the rule of that? When the transaction belongs to an asset, the rule is debit what comes in and credit what goes out. Debit what comes in and credit what goes out. Whenever an asset is purchased and whenever we are receiving that particular asset, we are going to debit that particular account. Whenever we are selling some asset, that particular asset is going to be credited. For example, if we purchase a building for cash, both this particular building and cash are related to the assets only. Cash is an asset, building is also an asset. As both building and cash are real accounts, we need to debit what comes in and credit what goes out. What is coming in? Actually, when you are purchasing a building, building is coming in. So debit the building account. And what is going out? Cash is going out. So we are going to credit that particular account. This is as simple. Whenever we are receiving an asset, we are going to debit the account. Whenever something is going out, we are going to credit that account. Not that every time both the transactions, if it is because it is a cash transaction, both they are asset accounts. Supposing that I sell a certain asset to Shah, one part of the transaction belongs to an asset, another part of the transaction belongs to a personal account. So depending upon the account, we are going to debit or credit the account. So I am not confusing. I will not be interested in confusing it. We'll look at that particular thing later. First, let us understand the transactions related to an asset account or a real account. Then, when the transaction is relating to a nominal account, what is a nominal account? A nominal account relates to the expenditure or a revenue, gain or a loss. If the transaction belongs to this particular kind of things, then the rule is related to debit all expenses and losses and credit all incomes and gains. Debit all expenses and losses and credit all incomes and gains. Debit all expenses and losses. Whenever there is an expenditure like wages, salaries, or whenever there is a a loss relating to the goods because of the fire or something, then we are going to debit that particular thing as a loss. So we are going to debit the expenses and the losses and credit all incomes and the gains. For example, if we pay salaries in cash, as salaries is an expenditure and belongs to nominal account and cash belongs to real account. Salaries forming nominal account, salaries forming nominal account will be debited, and cash, which is not part of this particular nominal account, which belongs to the real accounts or an asset account, is credited. So let me repeat what we have understood. When it belongs to the personal account, we need to debit the receiver and credit the giver. When we are going to have real accounts, when the transaction pertains to real account or an asset account, we have to debit what comes in, debit what comes in, and credit what goes out. When it is related to nominal account, all the expenses and losses need to be debited, and we need to credit all the incomes and gains. If you know this particular three rules relating to the personal accounts, real accounts, and nominal accounts, you are going to get 100% in accounting subject. Thank you. When the transaction belongs to the asset account or real account, we need to debit what comes in, credit what goes out. This is a rule relating to the real account or the asset account. Both are one and same. Debit what comes in and credit what goes out. So whenever a asset is purchased, that asset is coming in, so we have to debit it. Whenever we are making sale, that particular asset goes out, so we are going to credit that particular account. This is as simple as that. Let us take an example. If we have purchased a building for cash, if building is being purchased for cash, both the building and the cash belongs to the assets only. Both the building and cash are assets. So one is coming, one is going out. What is coming in? Building is coming. So debit the building's account, credit the cash account because cash is going out. So this is the transaction how we have to pass. Debit the building account and credit the cash account. But one has to understand the entry or the transaction may relate to two different kinds of accounts. One is personal account, another one is a real account. We have sold something or we have purchased an asset from somebody. For example, if the building is purchased on credit from Mr. Sham, we have to look at both from the angle of a real account or an asset account and also from the personal account, because this particular transaction involves both real account and personal account. When it belongs to the real account, that building relates to the asset account, we apply this particular rule. Debit what comes in. Building account is going to be debited. When it is related to when the other parties, the Sham is involved, he is giving it, so his account is going to be created as per the personal account rule. Okay, don't confuse yourself at this particular level. When it is a real account, we are going to debit what comes in, When something is going out, we are going to credit that account. When the transaction relates to the nominal account. What is the nominal account? Nominal account relates to the expenditures, incomes, losses, and the gains. If such transactions are going to be there, the rule would be debit all expenses and losses and credit all incomes and gains. Debit all expenses and losses, credit all incomes and gains. This is the simple thing which you have to remember. For example, if we pay salaries in cash, salary is nothing but an expenditure. So we are going to debit the account. Wages we are paying. We have to debit the wages account because we are going to pay it. Rent is there. Whether the rent is payable, we have paid the rent or we have received the rent. If we are going to receive the rent, that becomes an income. When we are paying the rent, it becomes an expenditure. So when it is an expenditure, we are going to debit it. When we pay rent, we have to debit it. When we receive the rent, then we are going to credit that account. Rent receivable account, rent received account, and rent paid account. So there sometimes interest is received, interest is paid. So such things are going to be there. Whether you are receiving it, whether you are paying it, whether it belongs to a loss, whether it is going to be belongs to gain. All the losses are going to be debited. All the incomes are going to be credited. This is what we need to understand. Thank you.